And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It is 6:07 as we get this pre-hump day edition of the show underway. And of course, it's the Real Investment Show. A few things to talk about today, of course, is here we are wrapping up kind of a big week in earnings. This is one of the larger week of earnings reports coming out from S&P 500 companies. McDonald's, others are reporting this week. Now, earnings are going to run over the next few weeks, but there's a big chunk of earnings that all come out this one week. This is kind of like the week where we really get to see a lot of this. And as I said before, and I talked about this a couple of months ago here on the show, as we were going through this whole pandemic crisis and earnings estimates were being drastically lowered, that, be careful about this because, companies are going to come in and they're going to beat earnings, and we're going to have a very high beat rate. We said this on the show. We'll see a 60 to 70% beat rate of earnings, and that's exactly what's happening. And of course, but that's because we lowered the bar so much. We call it millennial soccer when we get into earnings season because, everybody gets a trophy, everybody wins, and nobody gets punished because, they don't perform well because we lower the bar so much, they all get to beat it. But hey, that's the way the markets work, right? But the problem, though, is that earnings have declined to a great degree, and investors are paying way too much for stocks right now. And in fact, in order to rationalize buying those stocks at these price levels, we're having to use 3-year forward earnings, right? So estimates in 3 years in the future that these companies will grow back. The problem is, as always, is these forward estimates are always overly optimistic, just like they were overly optimistic this year. In January, expectations were that we were going to have $160 a share in earnings, whatever it was. And, now here we are, in the $90 range. So, that's how these things work. And this is why investors always kind of get themselves in a bit of trouble. Always pay attention to what companies are really saying, right? Not, turn off the media, focus on what you're doing. That's always going to get you into a much better position. But here we are this week, lots of news out. It's going to be kind of driving the markets. Also, we have the Fed out this week talking about, their policy and what they're going to do. Of course, no surprises coming out of the Fed. They're not going to cut rates because they're at zero. But more importantly, the real question is more stimulus, more liquidity, more quantitative easing. Are they going to do it? What else are they going to provide here? The markets are really dependent on this liquidity, but yet the Federal Reserve has been lowering the amount of investment that they're making in terms of their QE programs. They just released their schedule yesterday. Big reduction in the amount of purchases they've been making from the beginning back in March, where they're doing $75 billion a day. We're doing about $9 billion a week now. So those have really, really slowed down a lot, which means less liquidity for the markets. And of course, this is kind of what we've seen here lately is as the Fed's been tailoring back their liquidity, the market's been really kind of stuck in a big kind of trading range here over the last several weeks, really last several months. And as we've been kind of going through this. So, that's one of the big questions. The other big question the Fed is going to have to ask themselves is, and really it's going to be one of the questions I think that people ask is, what's going on with gold? Gold has had a huge spike here lately. Now, gold is generally a proxy for inflation. There's a very close correlation between the price of gold and inflation expectations, real yield. So if we take the Treasury yield and divide it by, what's happening with inflation expectations, there's a very close correlation. So what the market's saying is, and when we look at gold as an example, we're seeing a big surge in gold. At the same time, we're seeing a big decline in the dollar, and the dollar's been having a very sharp sell-off here. So this has got to give the Federal Reserve a bit of pause here about what they're doing policy-wise. The one thing they didn't get during previous rounds of QE that we saw back in 2010, 2011, 2013 was a big surge in inflation expectations or a big surge in inflation itself. And so the theory is that, quantitative easing and increasing the money supply doesn't really impact inflation, but this time there may be some indications that it actually is. And that could be the biggest problem for the Fed and for all of their quantitative easing programs, their supports for the markets, etc. The big problem is always inflation. Once they start getting a big push in inflation, basically a lot of their measures have to come to a halt because they're going to have to start talking about having to raise interest rates to quell inflation. Yes, they said that they're going to let inflation run hot here, but there is a limit to how much they can let inflation go up. Now, what's the difference? Well, the difference is that previously, back after the financial crisis, and when we, kind of look back at the markets over the course of the years, back after the financial crisis, the Federal Reserve was doing quantitative easing only, right? So this was all staying kind of bottled up within the financial markets and the banks, and it really didn't flow through to the main economy. The difference this time is they're actually sending money directly to households. Now, this is increasing spending. We're giving people more money than what they were making when they were working, so they go out and they spend that to the economy, and when they do that, that actually creates inflationary pressure. So the concern here now, of course, is that this transition from what was previously just monetary policy into modern monetary theory, which is sending money directly to households, helicopter money, so to speak, is now leading to real inflationary pressures. That is a huge game changer here because that's the one thing the Fed is ill-equipped to deal with and changes the entire gamut of what they can do policy-wise, and that could have a very, very big impact on the financial markets going forward. So, one thing to talk about here real quick, we're going to get into what the Senate proposed yesterday in terms of their bill. So now the big battle is going to begin, the battle between the Senate and the House. When we come back after the break, we're going to talk about what the Senate proposed, the differences between the Senate bill and the House bill, and what actually potentially happens here over the next month or so, because as of this week, the additional UI benefits are now gone. So that additional $600 a week is now gone, and this is going to really kind of change the dynamics for incomes of a lot of households which have become dependent on that extra money. But the market still remains kind of trapped in this trading range. We were unable to break out of that consolidation range that we've been in. We talked about this last Friday, but we are back onto a money flow sell signal here on the S&P as we talked about yesterday. So again, there's still pressure here on the markets, at least short term. So be a little bit cautious here. We've been talking about taking some profits off the table. Things are getting pretty extended here on a lot of fronts. So again, while we've had this nice run, there's a lot of support here between the 50-day and the 200-day moving average, which certainly provides the market support in the near term. But again, we've had a very big run from the March lows. Valuations are very extended, very expensive, and we're now getting through. Really, one of the big supports has been better than expected earnings because we lowered those earnings bars so much, but that's about to fade behind us over the course of this week. So as we get into August, as we've been talking about, the big risk to the markets over the course of the next really 4 to 6 weeks is going to be August, September. And as we start getting closer to the election, volatility tends to pick up. So again, kind of really watch the risk in your portfolio, watch how much risk you're taking, and again, just understand that volatility is likely to pick up here over the next couple of weeks, so we just want to be prepared for that, and we'll talk some more about that as well. Don't go away. More of the Real Investment Show coming up right after the break. Don't go away.
Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Let's go!
Welcome back. So it's 6:18 this morning as we kind of get this Tuesday edition out of the way. And, one thing here that is kind of, interesting is watching kind of what's going on now between the Senate bill and the House bill. So, the Senate, which is, still controlled by Republicans at this point, made a proposal yesterday, kind of their first draft of a bill, just $1 trillion. I mean, just, kind of a drop in the bucket at this point. We're just so far in debt now. What's $1 trillion between friends at this point, right? I mean, we just throw out these numbers without really any kind of connection of what it actually means. We'll talk about that in a minute. But it's interesting. So they put out this bill yesterday. Now, there's a couple of interesting aspects. So another round of $1,200 checks to households, right? So, that's going to be, well received. So people making, roughly, less than, kind of $75,000 to $90,000 a year, they'll get the $1,200 check. It gets phased out as you start to approach $99,000 in income. So, that's going to be well received, right? So this is like getting a tax refund. People are going to go out. Now they're anticipating the check. So as soon as the check shows up, they'll go out and they'll spend it. They'll buy something with it. So that's going to help the economy, at least short term, right? Provides that kind of stimulus boost. That's what I was talking about a second ago. That's why you're actually getting inflation potential risk here because of the differentials between how we're handling the spending this time around versus just direct QE into the financial markets. It doesn't solve a long-term problem, though, right? So because I give you a $1,200 check a couple of months ago and I give you one now, once the money's spent, the money's spent. So I get these little pops into the economy that are very short-lived. And so as soon as that pop occurs, then the economy kind of rolls back over, starts heading back down to where it is. So the trap, of course, this is the trap of what's happening here. The Democrats had proposed a $3 trillion bill, and this included checks to households, the continuation of $600 unemployment bits through the end of the year, all these other things, right? We're just going to spend $3 trillion. We're just going to throw it all over the economy, right? So that's the House bill. So now what happens is just technically what happens is that now the House and the Senate have to reconcile their bill. So just because the Senate proposed their bill yesterday doesn't mean that's how it's going to wind up, because now the House and the Senate have to agree on a bill. So they've got to reconcile their two bills to come up with the bill that they want to send to President Trump to sign. So how this thing looks in the end is one question. The other question is how long will it take to get there? And it's not likely to happen quickly. And this is going to be a problem short term, because there's a lot of people that are dependent upon those additional unemployment benefits, that extra $600 a week that expires this week. I mean, that's gone, right? So they're not getting that anymore. So the next couple of UI checks they get, this is going to be strictly just the unemployment benefit rate, and that's not much, right? So, all of a sudden, there's going to be a real risk here of seeing delinquencies on credit cards, a pickup of delinquency rates on mortgages, those type of things, until they get this bill passed. So the question will be how fast can they get their arguing done and get to an agreement that they can get a bill passed. And look, there's definitely an incentive to do so, and I think they will. But the problem for the Democrats is they've got to be careful not to do something that helps Trump too much in the election. And they're going to be kind of pushing back against anything that the Senate Republicans want to do, because they don't want to look like they're aiding Trump in this situation, because if they do, potentially that doesn't bode so well for Biden going into the election. So there's this kind of this political wrangling that's going to go on over the next month or two as well. But, one of the kind of the key things here for the Senate bill is the reduction in those additional unemployment benefits. The proposal from the Senate yesterday basically cuts those additional unemployment benefits, that extra $600 a week, in half. So they're still going to get some extra money for a period of time, but it's only going to be half as much. So again, the incentive here is that you can get people back to work, because if they're not getting paid more than they were making before, they won't be incented just to stay home and collect checks, right? So that's the thought process here. But the problem ultimately, though, is that there's just only so many jobs too, right? There's some people that just, even though they want to go back to work, they can't, because their job's simply not available. Companies aren't hiring. I mean, it's not like we have a lot of people just sitting around right now. We have a robust economy. Everything's cooking on all cylinders, and employers are just, clamoring to get new employees, and everybody's sitting around at home just going, I don't really want to work because I'm making more money sitting at home. That's not the case here. The case here is that there's not jobs available, right? Companies are going to hire back exactly, what they need to hire back, no more than that. And there's plenty of labor pool to work with, which is suppressing wages. Yeah, I'll hire you. Brent, you want a job, I'll hire you, but I'm only going to pay X, and you're not really in a position to bargain because there's a bunch of people out there that'll take your job. So this is going to be part of the problem going forward, is that, we may be trying to incent people to go back to work by cutting their benefits, which I agree with, right? But, at the same time, there's not a lot of jobs for them to go back to at the moment until we actually start to see an economic recovery. And that's going to take a while, right? It's not going to come just roaring back. There's been a lot of damage. It's going to take some time. I mean, there's roughly about 40 to 50% of small businesses that simply won't recover and they won't come back. So there's going to be less jobs. So this is going to be part and parcel of the problem. And we're going to see a lot of skewing to the employment data. We're going to see a lot of, data that comes out that suggests things are one way, but if you actually dig down into the data, there's going to be kind of a lot of indications that things aren't what they appear to be, and it's going to take a while for the data to catch up with reality. That's just the reality of it. When you have these type of very sharp contractions, it skews the data and the methodology. The Bureau of Labor Statistics is a good example of this. They've been reporting over the course of the last few employment reports that their data collection has been skewed by the pandemic and the shutdowns. So they are basically underreporting what the true unemployment rate is. So in other words, the report looks better than it probably actually is. And they're aware of this, so they just don't have a way to fix it and eventually the data's got to kind of work itself out over time. But so the point though here is that the big showdown is about to occur, and this is going to be the thing that really kind of drives headlines over the course of the next couple of weeks. In particular, is going to be this debate over what type of bill is passed. Chuck Schumer out yesterday. He was very upset because this mere $1 trillion bill by Senate is just ludicrous. We need to go big or go home. Is basically Chuck Schumer's
Freudian
slip. Not really. Is his methodology, right? So we just need to spend $3 trillion. We need to get money into the hands of everybody. We just need to, kind of go full tilt into this. But, the problem that we've talked about before is the same problem that exists currently, which is that more debts and more deficits don't improve your overall situation. While we're wanting to try to provide help in terms of money to households, et cetera, it sounds great on the surface. It's a trap that once you get into, you can't get out of. And this is where government is right now. Government has gotten themselves into this trap, and they don't realize it yet. But this is where you can't extricate yourself from it without causing pain. And that is going to be the problem now, because now we have entered into this realm where we are providing money directly to households in the form of debt. So we issue debt to send money to households. And it's believed to be a temporary measure. But here's the trap. Every time I go to remove those measures, everybody throws a hissy fit. So then the government has to come in and provide measures back, right? And what I mean by throw a hissy fit, basically the economy starts to shut down. And so when the economy starts to weaken again, then the Federal Reserve's got to step in. They've got to do more QE. The government's got to step in, provide more liquidity. That's the trap. And once you get into that, the only way you get out of it is to say, look, we're not going to do it. You're just going to have to suffer through this a bit and let the economy go through what it was trying to do to start with, which was to go through a reversion process. A recession is not a bad thing. We've talked about this before. Recession's not a bad thing. What a recession does is it eliminates the excesses in the markets, kind of resets the table, and allows for economic growth and prosperity to recur. And we keep stopping that process through government interventions. And so the problem now is we have gone down that rabbit hole to where we're now to stave off the pain of the recession because we don't want to deal with it. We're now providing money directly to households. Well, now it doesn't matter what you do from here because as soon as you extract that capital, the economic recession is going to reappear. So you're either going to have to let the recession occur, let the reset occur, or you're going to have to go full tilt into modern monetary theory and start providing a steady stream of cash to households. But even that won't create economic growth. It'll simply just keep the hole from appearing as fast as it would otherwise. Be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
And welcome back to the show. This morning, 6:34. Coming up at 7 o'clock this morning, as soon as we close out our show this morning, we're launching a podcast with Dr. Don Rich, who is the Chief Investment Officer for Esoterica Capital. And we had a really good conversation talking about, the economy, markets, kind of where we are in this current cycle, et cetera. And it was really a very good interview talking about the, discussions about, surrounding things like why the markets are detached from the economy and why there are, kind of companies struggling when other companies aren't, why wage growth hasn't picked up, a lot, we kind of a broad ranging topics that we covered. But anyway, it's a really good interview and it's going to come out today at 7 o'clock. So simply go by our website, realinvestmentadvice.com, click on our YouTube link right there on the top of the page and just subscribe to the channel. And as soon as we release it here at 7, you'll get notified of it. We'll also have it posted on our social media pages as well. So you'll get it there also. So just follow us on Twitter or Facebook. LinkedIn, we're kind of everywhere. So, but anyway, coming up at 7, we're going to release that. So one of the things that I talked to Dr. Rich about, and basically talking about the markets kind of been doing well since the bottom in March, and things have come back, but there really seems to be a disconnect between the financial markets and really the rest of America when you start looking at the economic prosperity kind of across the board. It really doesn't jive with what we're seeing in the markets. And among those issues are kind of, the extent to which the markets are overbought. And that's where we are currently, is this, we've gotten to ourselves in a position where the opportunity that should have come from the crash back in March didn't occur because of all the stimulus and the inputs and where we are now. So we eliminated the ability for investors to actually value invest. But here's what he said. 31, sorry.
I like to look at the price we're paying per dollar of profit. And so if you look at the expected profit margin over the next year, it has just fallen off a cliff. But of course, prices keep going up. So why is this? Is there actually a fundamental reason for the crazy risk taking?
And and that's kind of been the real question here. And when we're looking at this, right, the answer is yes. And it really kind of comes in 3 parts. The first being 4 out of 5 companies are paying a higher dividend rate than the 10-year Treasury right now, and money growth is running at 33%. So we've got this huge increase in money supply. But anyway, this is what Dr. Rich says about this. Cut 32.
Every $100 a year ago is now $133, right? And that money has to go someplace. And so when Chairman Powell says that the risks are unprecedented, he truly is putting our money where his mouth is, because we are just seeing money growth like we've never seen before in U.S. history or like anyone else is doing. So that's the second thing. That money has to go someplace. And the third thing, though, the most important thing, though, is actually real interest rates. real rates of return in the bond market are nearly minus 1%. And so investors are looking for a positive real rate of return. That's why they're driving up prices and taking this crazy amount of risk taking right now. It seems irrational, but there's actually a very plausible reason in this crazy world we live in.
And anyway, so this entire interview is coming up at 7 o'clock, and we go through everything, talk about wage growth, we talk about the vaccine, potential for that, what's going to happen. So anyway, that all comes out at 7 o'clock this morning, so simply get by our website, realinvestmentadvice.com, click on the YouTube link, and release that. But one thing he brings up about this whole issue of money supply is interesting because there's a belief that, we can basically solve our problems by, just raising taxes and printing money. And the more that we continue to do, obviously, if we just keep printing more money and we just keep throwing it out there, then eventually our problem will get solved. But the problem is that we have a debt problem, right? So we keep going further and further into debt in order to try to solve a debt problem. So you're trying to solve a debt problem with more debt. And that, historically, that has never worked out well. And there's plenty of countries around the world that have followed the same path, right? Japan's tried it. Italy's tried it. South America's tried it. And all these companies have wound up in very, very bad situations. It was interesting over the weekend. I had a conversation with a young girl. She's 22. And, she's very, motivated right now, right? So she's very into all the protests and kind of all the, kind of the mainstream kind of media talking points on, social media, et cetera. Very into all these, right? And it was interesting. So, I'm always fascinated to talk to people about this because, whether it's, the riots or whether it's, modern monetary theory or whether, it's just, the general, we need to change the world, we need to all be green. It's very interesting because it's a very one-sided kind of view. And it's simply just the view that they've gotten from their social media. So it's like, oh, well, where did you hear that from? Well, it was on my Facebook page, or, this is what I read on Twitter. And, if it's on Twitter, it's got to be true, right? But it's interesting once you start talking to them, two things occur. One, there is, at the beginning of the conversation, there is an absolute unwillingness to accept any view or information that contradicts their own. Right? And it's called confirmation bias. And we're all subject to this, but it's gotten really bad over the course of the last few years because of social media. We can lock ourselves into our own little information silos of confirmation bias on social media because we exclude everybody's views that don't agree with ours. So it's really accelerated this process that once we find, our quote unquote mission in life, then we only focus on those views that support us. So whether or not you agree with a certain situation, whether it's, green energy or the riots or whatever it is, we tend to lock ourselves in that view and only hear those views. We're unwilling to hear views that disagree with us. And so we had this conversation and we were talking about this, and I go, and so I started to slowly move the conversation towards the impact of debts and deficits and the impact on economic prosperity, because she's 22, graduated from college, right? Got her degree, no job. And lots of hopes though, right? Living at home with the parents right now, so it's all fine. But lots of hopes here that she's going to have the same life that her parents have. Now, her parents are very successful. They have a big house. They've done very well for themselves. But, he has owned his own business. He built his own business, really participated in the whole views of capitalism. And that's the interesting thing. This kind of view that's coming up is this idea that we need to tear down capitalism, right? We need to get rid of capitalism and move towards socialism. So we need to start printing more money. We need to, provide direct checks to households. Debt doesn't matter. That's the whole premise of modern monetary theory. Debt doesn't matter. We can just do this because we can just print money to pay for it. And there's no consequence, right? There's no consequence for any of these actions. But it doesn't lead to broad-based economic prosperity. It actually reduces it. And there's plenty of evidence throughout history and other countries that show this to be the case. I'm just not making this up, right? So we're having this conversation. I go, well, what about South America? What about Italy? What about Japan? And she, and there was no real answer to come back. It's like, well, that's different. No, it's not. No, it's not. You can't just pretend that it's different. But see, this is the interesting aspect of it, right? We have this idea that we're going to do something that everybody else has tried and failed at, but we're going to be successful at it. And it's going to provide that utopian idea of a society that where everybody prospers equally and all this opportunity is available for everyone. But it doesn't, in history, that doesn't show up. And it's too soon yet, right? It's too soon. It hasn't been long enough yet. But in a couple more decades, this generation that is promoting these ideas, when they're in their 40s and when they're in their 50s, they're going to realize the errors in their ways, and they're going to be pushing back. And it's always interesting because there's an old saying about how do you change a Democrat to a Republican? Give them money. Because all of a sudden taxes matter, right? Taxes matter. But the reality is that we have gone down this, as I was saying a minute ago, we've kind of gone down this rabbit hole. We've indoctrinated an entire generation into a misinformation program that these things actually work. But without the ability to have a conversation to where you can say, look, these choices you're making today, I understand that they sound good, but the results are not good for you. Without being able to have that conversation, the solution is never available. And so as we go down this rabbit hole, there's no basically returning from the pit until the end result is finally met. And if you really want to take a look at it, Japan's a great example. 30 years later, they've had no economic growth. Italy's the same way. Be right back after the break.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Welcome back to the show this morning. Gold's been a big topic of conversation here over the last few days. And of course, whenever mainstream media jumps all over something, it's probably the end of a move, at least temporarily. But gold's been all over the kind of the headlines of late. Gold's going to 3,000, 5,000, 10,000, whatever it is. Silver's had a big run here lately. And that's not surprising because of the policies that we've been doing. There's always been this risk of the threat of inflationary pressures, right? So, we've had this huge surge as Dr. Rich was talking about in our interview, which is coming up at 7:00 this morning. He was talking about the increase in the money supply. So we've had this huge increase in the money supply. The U.S. Treasury right now is sitting on $1.8 trillion in cash. And that's for, whatever this next bill is going to be, where we send out another, $190 billion or $1 trillion, whatever it is, to, different programs, more UI benefits, et cetera. That's what the cash is there for. But we've had this huge increase in actual money supply. So, the precious metal markets have caught up on this. And inflationary expectations have caught up with this. So there's a genuine concern right now in the economy about a spike in inflationary pressures. Now, this is the worst possible thing for the Federal Reserve. The Fed's going to meet this week, and we're going to hear from them, as I said at the beginning of the show. But the worst possible outcome for the Federal Reserve right now is a big spike in inflation. As long as inflation expectations and as long as inflation itself remains low, they can print money, they can do QE, they can do all these things. And remember, that's the whole premise to modern monetary theory. There's no limit to modern monetary theory except for inflation. Now the markets are concerned about inflation. And again, inflation really has various forms. You know, the way we calculate inflation in terms of CPI really isn't a valid measure. It doesn't really quantify inflation for people that live in California and New York versus Texas. It doesn't really calibrate for inflation between age groups such as, millennials and boomers. Those type of things. Every group has really a different rate of inflation, and it also depends on where you live. But, CPI is the measure we have, and that's what we calculate COLA adjustments for Social Security, et cetera. It is what it is. But what the market's telling you right now is that there is inflationary pressures in the economy. Tips yields have been dropping. The price of tips have been running through the roof here lately because people are buying tips as a hedge against inflation. Gold's going up as a hedge against inflation. The dollar's been declining because of the threat of inflation. And now those have all gotten to extremes in the short term. So, for instance, the U.S. dollar is extremely oversold. We're about 3 standard deviations oversold right now in the dollar. So I think there's a real risk here. You're going to get a counter trend bounce in the dollar that'll pull some of the froth out of gold temporarily. And, all you need is a little bit of a headline here, about, the economy or whatever it is, that, kind of sparks a reversal, kind of a repositioning. Things kind of get too far, things kind of move too far in one direction or the other, so they kind of correct a little bit, and then you get the next move. So, right now, if you said, Lance, would you buy gold today? I'd say no, because it's too extended and the dollar is too oversold. However, you get a retracement on this for one reason or another over the next month or two. I think you'll have a good opportunity. And we own gold in our portfolios. We'll add to it on a pullback. But again, it's just right now. It's just in the real short term. It's just gotten too far ahead of itself. Too much exuberance. And again, when you start hearing about it on TV, 24 hours a day, and every article you pick up is about gold, that's pretty much tells you we've kind of reached an exuberant phase of a particular move, and you're going to have a correction. But again, I'm not saying you shouldn't own gold, because I think you should. Because what we are doing in terms of, $1 trillion bills, $2 trillion bills, whatever this bill turns out to be on top of the $2 trillion bills, et cetera, this is all winding up in an increase in the money supply, which the difference is now, if we were doing just straight QE as we did back in 2010, 11, 13, if we were doing just QE where it was remaining bottled up between the banks and the Federal Reserve, there wouldn't be a risk of inflation here. But the difference this time is that we're sending money directly to households. That potentially creates inflation because you're creating artificial demand, right? So I'm giving people money to go out and spend, which creates demand for products, goods, and services, which as soon as I'm a business owner, right, what do we see restaurants do? Good example of this. Go to a restaurant, and not all restaurants, but there were several that put on a COVID charge, right? Because they're having to run reduced staff. They're having to pay bills. So in order to do that, they needed to raise more capital. So they would add a COVID charge onto your restaurant tab, right? But that's inflation, right? I'm paying more for it. I'm paying more for the same meal. No matter how I get there, whether it's a tax, a fine, a fee, whatever it is, or just higher prices, I'm paying more for that good or service. So if businesses know, right? So if businesses know that the government's about to give everybody, some money, I'm going to move my prices up a little bit because I know I'm about to get demand. Especially if I have a product that's in demand, I'm going to move my prices up, right? So that's going to be that's the impact that's going on here that's different than what we did under QE. Because now we're actually creating the one thing that actually creates inflation, which is artificial demand. Artificial demand, limited supply, higher prices. That's just it. The problem is as I stated earlier, though, is that this is a difficult challenge, because once you go down this path, you've got to keep doing it. Because as soon as I stop providing that liquidity, demand drops because it was artificial, right? Nobody's working. Everybody didn't go out and get jobs to create more money to spend that was given to them. So they spend it, then it's gone. And if you don't give it to them again, then the economic growth goes away. That's the rabbit hole. And here's the other part of the rabbit hole. If I give you $1,000 a month this year, I'm going to get X amount of GDP growth. Next year, if I only give you $1,000 a month next year, I get the same. I have 0% economic growth because we measure GDP on a year-over-year basis. So if I don't change the amount of input that I'm giving you, then I'm not going to have any growth. My growth rate next year will be 0. If I cut it, it becomes negative, right? So the other problem is that once I go down this rabbit hole, I've got to keep increasing it every year to keep economic growth going. And of course, this all requires what? More debt. And since we ultimately have to pay for the debt, it requires more taxes. This is why we've talked about here recently on the show is that, we've all gotten very used to low tax rates. Those are going away. This has always been one of the big challenges that's going to come down the road is how do we pay for all this? And again, as I was trying to explain to my young female friend, is that, this all sounds good right now, right? But you eventually have to pay for it. And you're going to pay for it in a variety of manners. Now, let me tell you how that conversation turned out. Didn't change a thing. She at least listened for about 10 minutes, but that was about it. But didn't change the attitude, right? And that's not going to happen. It's too ingrained now. Now that colleges are now ingraining this idea into individuals, ingraining these economic theories, ingraining these ideas that, history isn't what history is. History is somehow different this time. Ingraining these ideas, these thoughts, these expectations, it's not going to change the outcome for the better. These aren't policies that lead to better outcomes. And that's what we're supposed to be working on as individuals. Improving our own situation so that our situation helps improve the situations of others, because how do we improve economic growth? We produce. We go out in the world, we create things, we produce things. We produce, we get a paycheck, we consume. That consumption puts other people to work. They can then produce. They then create an income that they can go consume, and then that puts other people to work, so forth and so on. That's the virtual cycle of economic growth that you're hoping for. An economy that lives off in a government doesn't have that virtual cycle. So economic prosperity is weak and weakens over time. But that's where we've gotten misguided over the years. And we've lost the idea that production is important. And technology, while it's great, right, has a very dark side to it. Increased productivity has a dark side to it. And we're now going to have to make some tough decisions down the road. Now, not this year, not this month, not next year, but eventually we're going to have to start making some challenging and very tough decisions if we want to try to reverse the process and reverse the path that we've taken. Wraps up the show for today. Be sure you're by the website. Coming up right after the show, we're going to release our podcast with Dr. Don Rich talking about the markets, the economy, the outlook, the future. That's all on the website coming up 7 o'clock right here on our YouTube channel. Simply go by our website, realinvestmentadvice.com. Click on the YouTube link there. While you're there, also, make sure you're registered for our upcoming Retirement Right Lane class that's coming up on August the 8th. You don't want to miss that, especially if you've laid off recently, need some help with your finances. They could do a great job with that. August the 8th. Register at the website right now, realinvestmentadvice.com. Stick around, though. Chris Salcedo's coming right up.
It's a rich man's world.